Right now, we are witnessing one of the strongest stock market rallies in history. Asset prices are currently pushing through previous all-time highs as the market enters a phase of rapid, broad-based price inflation across multiple categories. The speed of this move is staggering. The market swung from oversold to overbought in just 11 days, the second fastest rebound on record. The Nasdaq even recorded a 13-day winning streak, its longest run since 2011. These gains extend to digital. Bitcoin recently surged 13% in the same month it rose 12%, drawing in institutional capital from firms like Goldman Sachs and Citigroup, even after the coin had dropped 30% from its peak. But these numbers reveal a deep structural split. Wall Street assets are surging, while everyday consumer sentiment moves in the exact opposite direction. Looking at 70 years of data, the severity is clear. Consumer confidence has dropped to its lowest point ever recorded. Spread financial pain. While headlines focus on market records, the population is struggling with the cost of groceries and fuel, creating a deep sense of anxiety about the current economy. We are effectively living through two separate economic realities at once. Because Wall Street and Main Street are measuring entirely different data points, understanding that gap is the only way to protect your capital. Main Street's outlook is dominated by a stealth tax, the cost of nearly every consumer crude oil. It is the primary commodity powering the cargo ships, freight trucks, and tractors that move the global supply chain. Economists have tracked a direct correlation here. Every $10 increase in the price of a barrel of oil raises broader inflation by 0.2% and simultaneously slows down overall economic growth. Recently, oil prices climbed from $57 a barrel to over $100. That shift alone went back up to 3.3%, hitting consumers at the grocery store almost immediately. This persistent inflation has forced the Federal Reserve to keep interest rates frozen. Plans to lower borrowing costs have been delayed, with the market now pricing in the next potential cut years into the future. For the average family, this means borrowing costs remain high, particularly for anyone looking to buy a home or refinance existing debt. These high mortgage rates have effectively stalled the housing market. Prices are now stagnating or dropping across the West Coast and Sunbelt because the cost to borrow has exceeded what most buyers can afford. Sentiment is at historic lows. Everyday people live in the today economy, where the costs of living and borrowing are high, with no sign of immediate relief. While Main Street struggles with current costs, Wall Street investors continue to push asset prices higher, seemingly ignoring the pressure of inflation and high interest rates. This happens because the stock market is a forward-looking mechanism. It ignores today's grocery prices in what it expects corporate earnings growth to look like 12 months from now. However, a significant variable is approaching that could disrupt this optimism: Jerome Powell's scheduled departure from the Federal Reserve. Kevin Warsh is currently expected to take his place. Warsh has openly advocated for the Fed to shrink its balance sheet, which would effectively reduce the amount of money circulating in the economy. This transition charged. Warsh was a Trump nominee, and while he maintains he would remain independent, there is significant speculation and political pressure for lower interest rates. History suggests that this change carries significant risk. Since 1930, the stock market has seen an average decline of 16% during the period when a new Fed chair takes office. Wall Street is currently betting on a smooth future, but that volatility that comes with a new Federal Reserve regime and sticky inflation. The most common mistake for retail investors is trying to time their entries and exits based on the latest economic headlines. The data shows the cost of this strategy. Investors who exited during the recent market dips while waiting for clarity entirely missed one of the fastest price recoveries on record. Market timing is difficult because institutional funds use high-speed algorithms and internal data that give them a significant lead time over the average person watching the news. To navigate this divergence, many investors have the impulse to react, substituting market timing with a strategy of automated, consistent investing. This involves letting an asset allocation to maintain purchasing at regular intervals, regardless of the headlines. Maintaining this schedule ensures buying at low prices. Historically, staying the course yields better results than trying to predict the bottom. Financial opportunity often surfaces when uncertainty is at its peak. Maintaining a consistent investment schedule is how you capitalize on that uncertainty, without letting the emotions of a fractured economy dictate your financial future.